Quick hit of business news now. Joining us is the independent analyst Evan Lucas. Evan, it is good to see you. It was a story by John Kehoe in the AFR that caught me by surprise this morning, and it was quite interesting actually. He was reporting that the fixed rate mortgage cliff that was to be expected, it never came in the end, or isn't coming yet. So was it all a myth?
I wouldn't say it's a myth, Pete. I'd say it probably answers that the system works. And what I mean by that is that sometimes we forget when you actually go and get assessed for a loan, that banks are not assessing you at the rate that it is today. They're assessing you at the rate that it could be above and beyond, sort of basically extending you. That's why sometimes you get rejected. So if you even look back during COVID, they were still assessing loans at between 3 and as much as 4.5% above where they were at the time. Now, we know they're a little bit higher than that now. But the other thing that was happening because of the low rates is that we were actually doing something Australians don't normally do, which is that we were saving at an incredible rate of knots. And all of that put together sort of explains why the cliff hasn't happened. Then the final part of the equation is that if you look at anything around behavioural finance with this, one of the questions that's always asked is, what is something that is completely non-negotiable that you would actually give up in a time of crisis like we have now with the cost of living? And housing normally sits at number one, along with education. So all that together, we will forego everything else to make sure that we can keep the house over our head. We will also have savings buffers that we haven't normally had before. And then also the fact that the banks had assessed the amount of money that we could borrow at a level that is we're probably currently at now. All that probably explains why the cliff, as it's been known, hasn't eventuated. Doesn't mean we're not under stress, but we haven't had the cliff that we looked at the idea of basically that we would have to sell our homes, foreclose on everything, and there would be doom and gloom the world over.
Okay. Might this mean, it looks like that's already happening, but on multiple fronts, but might the RBA look at that, we'll go and think, well, gee, folks have got a lot of cash saved up. I think we'll be okay to hike interest rates one more. They'll be able to handle it.
Partly, their data is starting to show that the stress is there. Their data is also showing that for the first time, we are now actually moving into credit. So what they're finding is that we are now using credit to pay for our day-to-day items, and that's a concern for Martin Place in terms of what they see. We also know that they're looking at those buffers I just talked about, those savings buffers. They're exhausted for particularly those cohorts that are under 50, and we've seen that come out not just from the RBA, but the banks themselves have told you. There's a very, very telling chart from CBA that showed that basically anybody over 55 is making money because their savings are with CBA and they're making a bit of money on interest rate hikes. Those under 55 are actually now having to really draw down. So they are looking at that. They're also, basically saying very clearly that unless we see a fairly steep re-acceleration of inflation, they're unlikely to change the cash rate. Doesn't mean they're not going to leave it at the current level for a long period of time, but all central banks are starting to lead to that. They're saying very clearly that unless there's a re-acceleration in inflation, rates are now locked in and we're not going to really move.
Okay, Evan, we are a bit squeezed for time today, but appreciate it. As always, we'll talk to you soon.